Welcome, everybody. Thank you for joining us. I know you probably just put a full day of work in, as did we, and you're almost to Friday tomorrow. Hopefully, you're getting ready for the weekend, but we do appreciate you taking some time out of your day to join us and talk about what we love and what we do day in, day out. So, what we're going to kind of go through today is just a quick power hour, try to give you some high level concepts of things that we really enjoy. Hopefully you'll enjoy it, but it's going to be really high level today on what we do here at Buckingham Investments, how we help our clients scale their rental portfolios, and how we leverage a basic human need to achieve financial freedom. So we hope you get a lot out of it today. The whole goal for today is just to walk you through this. If this sparks any interest for you, or if you find yourself gravitating towards one of these strategies, obviously we can't do all the logistical knowledge with you today, but if you have any questions or you want to reach out to us and maybe learn your situation a little bit more intimately than the high level we're going to cover today, that would be awesome. We'd love to work with you on an individual basis and solve whatever your goals are and however you're scaling your portfolio. But for today, we're just going to do general high level concepts, give you a couple things to think about, maybe set a baseline for you and see where you guys are in your journey. So with that, today's plan, we're going to cover a couple things. We're going to go over who we are. We're going to go over your real estate team, which could be us potentially. That's who we are, and I'll explain that in a second. Or if you're building a real estate team, maybe how to and how to maybe vet the team that you're working with. We're going to also cover creating your own real estate investment plan. Believe it or not, a lot of people just buy a property and they worry about the planning and stuff later. We try to focus on the planning first before we do anything. We're going to go over some data as far as what we do on a daily basis since the 60s. We love data. We're data nerds. And it's a little dry, but I think it's super helpful for our clients to understand what the local market is doing and how can it affect their strategies. Speaking of strategies, we're going to go through two client concepts, kind of one on either end of the spectrum, related to scaling. What is it like to scale a rental portfolio? How to scale? There's a couple options we'll talk about. Most important, goal setting, where your starting point is, doesn't matter, but where is it? And kind of building that buy box. What type of buyer are you? What type of investor are you? And then if we have time at the end, we'll go through a little deal analysis on one of the deals that we're going to cover that was purchased recently. So that's kind of setting the table for what we're doing today, and we'll have an action step or two along the way that you guys can follow along and maybe do it yourself or not. Totally up to you. So with that, we will start with who we are. So Buckingham Investments has been around since the 60s. Jack Buckingham and Marty Stone founded the brokerage on a very simple idea. Why isn't everyone doing this? Jack Buckingham was an aerospace engineer at Hughes when Hughes was around, and Marty Stone was just a local real estate broker. And they got together on the concept of let's buy local multifamily, local apartment buildings in El Segundo at the time, which El Segundo back in the 60s and 70s wasn't what it is today. But they saw the future. And Jack, being a very brilliant mind, he worked on the lunar landing module where the legs come down and landed on the lunar surface. Statistician, very bright with math. And he came up with a lot of concepts. Him and Marty wrote a lot of books that are still on Bigger Pockets as one of the top sellers, still to this day. But a lot of number driven, a lot of concept driven stuff that makes this investing thing that's super complicated very, very simple. So the three pillars that they founded back in the 60s was learn, then let's plan, and then let's invest. Very different from most brokerages. Maybe you've been a part of a brokerage model that's different, or maybe you've been a buyer with a different broker where it's usually buy first, then maybe we'll talk about what you did, and we'll plan for the next purchase without your goals. So that was the founding genesis of Buckingham Investments. Back in the 60s, we grew up to a large company. In the 80s, kind of wound it back down. And then Anthony Walker, our CEO and my managing partner, took it in the early 2000s, and we've been growing it ever since. So that's a little bit about Buckingham. What you're looking here on the screen, though, that's kind of the history. What you're looking at is kind of what we do and what we feel a real estate team should offer. So a couple things to note here. One, I think a track record is a good place to start. Company that's been around since the 60s, multiple market cycles, and has survived. Tracks local data since the 60s. We have plenty of data and charts and all sorts of things to understand what the market has done, what it's doing now, and maybe what we can project in the future based on past performance. Other things to note, other than the transactions we've done and all the things, I think it's important that we give back to the community. And Buckingham has been doing that, and we've won our third star, South Bay's best. We only have two up here. We just got the notice for the third one for this year, 2025, that we can announce. But we give back to the community, and we do more than just real estate brokerage in general. Couple things to note as far as practice what we preach. Not a lot of real estate brokers, if you've been a part of transactions, not a lot of them own, which is very surprising to me, even to this day. Some agents have been doing it 30, 40 years, and they still lease their condo and lease their car. It's very surprising to me, but that's a strategy, and I understand it. But Chrissy and I, most of the agents, if not all the agents that work here at Buckingham, we're all owners as well. And so we gave you a little track record as far as what Chrissy and I own, and my family as well. I kind of come from two portfolios. My family's been doing this since I was a kid, which I'll explain a little bit later. And then my wife and I, our three kids and two dogs, have started our own portfolio as well. So you're talking to people that not only, sell this product and work on this product day to day, but we also live by it and we own it and we participate as well. I think that's extremely important when you're considering investing with someone or working with a broker. I think it's important to know that they own too, so they can understand all the challenges, the pros and the cons that maybe someone who doesn't own doesn't have that experience. Following our circle here, when you're looking at like what you're investing in, I think it's really important to categorize what it is. For example, we work with a basic human need. If you think about it, we're working with apartment buildings, and the apartment buildings are valued based on the income they derive. People need a place to live, right? And when you talk about supply and demand in California, we're predominantly a renter state. It's probably good to own some of those rental units. And this is not a, Airbnb luxury model. This is not getting cute with different ideas. This is tried and true, basic human need. Provide a place for someone to live, take care of that place, take care of the community, and we all grow together. And usually we could start from one door, like our diagram, maybe monopoly based. You start with one door, you start with that, brown property, and then you get around the map, you go through some cycles, and now you're adding hotels and doubling doors and all sorts of fun things. So I like that diagram because I feel like it covers a lot. Moving into our ecosystem. So I think it's important to talk about at Buckingham Investments. We've been around for a very long time. We have a lot of referral partners that aren't Buckingham umbrella. We stay in our lane. We do real estate brokerage, but we have lender partners. We have contractor partners. We have CPA partners, inspectors, property managers, anything you need, structural engineers, ADU specialists, cost segregation studies, right? We have all the ecosystem at our fingertips that we can help plug you into, or if you're building your own, we can help plug that in as well. But I think an ecosystem is really important for any brokerage that you're working with, especially when you're buying this type of investment. Rounding out our circle here, it's a small icon. My eyes are bad, so if you're squinting, it's all right. But our market research is second to none. We are not the CoStar research portal. We're not the Zillow algorithm. It just calculates a couple things. We take our own data, and we've been doing this since the 60s, and we do it on a quarterly basis that we provide to our clients for free. and it tracks all the apartment sales here in Southern California, predominantly the South Bay. Um, and it tracks every metric from price per square foot, price per door, gross rent multiplier, cap rate, sales volume trends, inventory volume trends, all the leading and lagging indicators you need and what we need in order to help make the right decision for you based on what our goals are and what we're trying to do. And the last thing, I saved it for last, is planning. I will probably say that word too many times today, but planning is so important. I just can't stress the value of planning, but more importantly, following up on that plan. It's great to put a SMART goal in place, but if you never relook at it, right? Or if you never revisit it or tune it up, it's meaningless. So part of planning is checking in on that plan, right? We check it with our clients on a quarterly basis if they'll allow us to, or an annual basis. And that plan is constantly being checked, fine-tuned, areas for opportunity, areas we need to fix, etc. So I think when we're talking about who we are or who you might want to work with, these are things that I would consider when you're looking at a residential real estate brokerage company like us at Buckingham Investments. So, Chrissy, anything I'm missing there? Did I hit all the points that we're looking at?
I think you hit all the points, like talking about, how we can help service you. I think a good point to mention too is that you are in the middle of this black little icon here. That is you. This is your rodeo. This is your real estate journey, and we're a teammate of yours that can help you essentially. And we can connect you to other teammates that do great work. But it all depends on what your goals are, what you're looking to do, and we just can provide the knowledge and experience to help get you to where you want to go.
That's right. And the last thing I'll say is to kind of fundamentally, some people look at Buckingham Investments and it's kind of hard to decipher. What are they? Are they a fund? And we'll talk about who we're not. But just to re-emphasize on the foundational level, we are a local real estate brokerage. Chrissy and I are local real estate brokers and investors, right? But that is our primary function. And that's also how we get paid. We don't charge you a first phone call fee. There's no annual check-in fee. There's no fees at all to work with us. We're a service-based brokerage that wants to provide services. And if you like the value, 9 times out of 10, you're going to work with us. And that's how we're going to get paid, is we're going to get paid working together, closing these transactions, taking your 2 doors to 100 doors. And as they say, a rising tide, all ships rise together. That's the goal, is to work with our clients for 20 to 25 years and turn what this little plan is, this little idea of a plan, into something big, financial freedom, whatever it can turn into. So I'll end on that slide with that last point there. But I think it's also to talk about, who are we not? A lot of, YouTube videos, a lot of, we'll call it education out there in the marketplace. So let's kind of cut through a lot of that fat and say who we're not. We are not a fund. We are not an equity firm. We're not raising equity. We are wanting to work with individuals just like you, right? We're not a leasing agent. We don't do short-term operations. We don't buy a building, take all your money, and then promise these returns on a short-term basis. That's a luxury model, not a basic human need. We don't manage these properties for you. We manage ourselves. Well, I'll speak for myself. I manage my properties. Not everyone else in the office does. But we don't manage the properties. We manage the managers, which you would employ. We are also, this one's a big one for me, we're not content creators. The investing world right now is, follow your favorite content creator. They look like they're a real estate broker. That's what they call themselves, but they're just creating content. They're just creating clicks. There's no logistical support, nothing beyond that. We're not that. If anything, this is the best content we can create, and it's a couple bullet points. We're just real people, right? I think that's pretty important in today's world. Another big important one, we're not part-time agents. Chrissy and I and everyone in the office, this is all we do. We're not the uncle that has 3 jobs and does some real estate on the side. We're not the sister that has a full-time job and does real estate from 8 p.m. to 9 p.m., whatever. This is our full-time job. This is what we've been doing. And I'm coming up on my 10th year with Buckingham. and I plan to be here for another 30 years. I think that's also really important when you're working with a broker. Are they part-time or full-time? Might be simple to you, but interesting maybe to others. We're not stockbrokers. We are not going to give you financial advice in the equity markets. We're not going to time the market, buy low, sell high. We are participating in a long-term basic human need. There's no timing the market with what we're doing. So a lot of people come to us and look for those types of advice, and we'll give it to them. We'll give them some short-term strategies and walk them through that. But we're not market timers, and we're not playing the stock market. This is a completely different mindset. And the last one is we're not real estate gurus. We are people with a laptop and a PowerPoint presentation. We're real people just like you. We just happen to have some experience in what we do, and we also happen to love it, and we're very passionate about it. But we're not selling you a course. There's no sale, 35, 30, 40 minutes from now. There's no big bang to go out with and sign up for my $20,000 course to learn nothing. We just are very passionate about it, and we're taking time out of our afternoon and evening, just like you are, to spend it with you guys. So just want to make it very clear who we are and also who we're not. So with that being said, give you my quick little story. It's a long one, but I'll condense it because we're not here for me. We're here for you. But that is my family over at our church at St. Lawrence. I was born and raised in the South Bay, predominantly Redondo Beach, Torrance, and Lomita. And my three girls are growing up. We have two dogs. My wife and I have been high school sweethearts, and we've been through a lot. But we started out just South Bay people. My mom and dad started investing when I was very young. I was mowing the lawns for my parents' apartment complexes, not even realizing they owned them. My mom and dad were in the garment industry back when it was a thriving industry. They did well. They came from couches and turned it into something really big. And they started buying 2 to 4 units in Redondo and El Segundo back in the 80s. And that's when I started mowing lawn and fixing fences and doing things as a kid with my dad that I cherished but didn't realize what it was until my dad passed away in high school. And then being the oldest kid, I was thrown into the family finances into college and helped my mom get through the death in the family. And real estate was really impactful for my family to get us through all that and take care of. I come from a large family. My brother, my sister of blood. We have 2 older adopted brothers, and we have 4 guardian girls, all with my mom without a dad or without an income at that time. And so real estate has really gotten us through a lot. And it also turned on the light bulb for me in college. This is what I want to do for the rest of my life. I bounced around like a lot of us, went to UC Santa Cruz, played soccer, played a little bit of professional soccer and professional football after that. But shortly after that, I came back to my roots. And like I said, this is my 10th year with Buckingham, but I've been working within real estate investments since about 2006. My dad passed away in 2003, and that's when I had to jump into the family finances. So I have a unique understanding, both from a product of real estate, a benefactor of real estate, but also going through some hard times and getting through them, and all the way from ground level mowing lawns to high level selling, exchanging, buying, you name it. So I like to share my experience because I want you guys to know that I'm just like you and hardworking individual that is very passionate about what we do. And I do it for my family. That is my why. So Chrissy, please tell me about your family.
Yeah, so this is my family here. I have a little bit of a different upbringing than Matt, where my dad hated real estate. He did not understand it. He didn't make good decisions with it, and when I told him that I wanted to get into real estate, he's like, "Are you sure?" And I was like, "Yeah, I'm gonna do it. This is great." I was so excited. I first thought I wanted to flip properties, be like Joanna Gaines, and do fixer upper. But then I met the people that work here at Buckingham, and they're like, "Hey, what about investing for more buy and hold, long term, more passive income?" I was like, "Well, passive is way better than active. So why not?" And when I got my license, I joined here at Buckingham. And it was great. I loved it, jumped right in. I was able to I did so well my first year. I was able to buy my duplex my second year, live in one side, rent out the other. I had my fiance, who's in the picture here, had him buy a duplex too. So we're building our doors, I just really fell in love with real estate and seeing what other people have done here at Buckingham do. I'm like, hey, I want to be with the people that are doing it and actively doing it. So that's why I joined the brokerage here. And I'm all about family as well. When I learned about how you can scale up, I helped my sister sell her condo and buy 11 unit apartment building and triple the cash flow. So she didn't have to go back to work after she had my nephew. So once I realized the power of real estate and how it can help people, my family and all of our clients and friends, I really was excited about it. And it wasn't until I helped my sister with the apartment building that my dad was like, oh, okay, I get what you do now. It's pretty cool. Uh, which is a nice little pat on the back, and I was excited about it. But yeah, but that's why we're here. We love teaching people about it because weren't taught this stuff in school, you know? And so when I found out about it, I was excited about it. And everyone, we just want to share with everyone essentially. So yeah, but let's get into the meat and
Absolutely.
potatoes.
That's why we're here. So now you know who you're working with. Now you know who's talking to you through the screen. I know some of you have been a part of our journey and have been to some of our in-person seminars, maybe some of our webinars in the past. So some of this will be what you've seen before. Some of it will be new. But what you're looking at right now is the start to your plan, believe it or not. This is the equation that we leverage. And this is not a Buckingham equation. This is time value money or compounding interest. And it's really simple, but it's also really fun to complicate if you want to. So talking about the variables, future value is important to consider. Future value can be your dreams. Future value can be a financial freedom number. If you're that, myopic and you have a number, it could be, I want to pay for my 3 daughters, weddings. It could be a boat down the road. It could be something in the future that you want to pay for, or you want to have the ability to be a part of, travel, you name it. So I think future value is your variable. You guys get to decide where you want to be in the future. And it could be dollar amount or just big idea to start with. But your future value is equal to your present value. Now, present value is going to be your starting point. And that could be anything. That could be new cash. That could be an IRA account. We've helped people with solo K, retirement funds. That could be, I just inherited this random duplex I didn't even know my family owned. What the hell do I do with it? That could be, I already have 5 properties. I already have a good sized portfolio or more. I just don't know what to do to scale. I'm stuck. Your starting point could be anything, is the point that I'm trying to make with your present value. And I think it's important to consider present value is a couple things here. It's going to be considering your down payment. It's going to be considering some closing costs that might be a part of that transaction, right? It's going to consider maybe a rehab budget that may be involved. It can consider reserves or should consider reserves. So we take this present value for each client and for ourselves, and we allocate it in these buckets to make sure we're seeing everything. So there's no surprises as we go along the plan. So that's going to be your present value. And that's going to be times 1 plus your rate of return. That is your R variable. And your rate of return with what we're doing in real estate, you have 4 of them. And we'll talk about them here in a second. But you have 4 elements of return. And then it's to the power of N, right? So number of periods, otherwise known as time. So most of us have time on our hands. N is the most sensitive variable in this equation. The more time we can have intervals compounding on itself, the more that graph continues to go parabolic. And it might look funny because it's like, wow, that's a simple graph and it's kind of pointing straight up. That's exactly what happens. It just takes time. We laugh in the office. It's a get rich slow strategy, but you do get rich and it is slow, but it happens. And this is the equation that is responsible for it. So if we move on into the next segment, we're going to solve a word problem. And this is your word problem that you guys get to work with. And we help our clients walk through this, but it's the same idea. I'm going to invest present value dollars for N years or any periods of time at a sustained rate of return of R% and be worth future value at the end of the plan and future value dollars. So what you're looking at right now seems super simple, and it is, and I love how simple it is, but it's really impactful. This is your plan. This is the start of your plan. And I think it's important to write it down. That's what we do here with our own buildings. Each one of us have this, and we try to encourage our clients as well to go through the mental math and kind of play with these variables and make them real to you, because the future value and the present value are yours, and we as your teammate get to help juice the R as high as possible, juice those returns as high as possible, and make sure it's sustainable for how many years we're going to be doing this. So I think it's important to remember that this is a part of your plan in relation to your goals. So what does it look like as far as that's awesome, high level? Let's look at some chunks. So the numbers up on the left, starting value 200,000, that is irrelevant. We just have to have a placeholder there. It could be anything. I bought my first building with an FHA loan with 5% down. And we could talk about that offline, different purchase models. But we need a starting point for some graphs. So what we're looking at here is we're assuming a $200,000 present value. We are assuming your N variable time periods is 25 years. And we have a return of equity that is running through the model of 5%, 15%, and 30%. Now, a couple things to talk about there. What we're illustrating is the difference between risk, right? So if we look in the upper right quadrant, we have a 5% return on equity, and the graph is nice and smooth. We go from $200,000, future value turns into roughly $700,000, very smooth, not as sexy potentially, but it's very low and slow. We'll call that least amount of risk possible, and probably no leverage, no loan product on that type of investment, which is okay. Believe it or not, that's how my family started. They started, debt was bad back in the 80s. And if we all remember interest rates back then, they're a lot higher than they are today. And so a lot of people might have started out that way, including you. If we move down to the bottom left, we're talking about a 15% return on equity, where our $200,000 over 25 years turns into $6.5 million. Very real. And on the bottom right, we have the most risky, the highest leverage, turning over doors, high frequency, turning 2 doors, 4 doors, 8 doors. I'm just doors coming out of my ears. And we turn our $200,000 starting point into a $141 million equity position. Again, very real. I know these things are like, there's no way. It's real and it's very possible, but you got to consider the risks. You got to consider the frequency and what we're doing within that, which we'll talk about. But these are just illustrations as far as what risk is going to go with your strategy, what leverage or no leverage we're going to involve, what area we're also going to be located in. Are we in an A plus area? Are we in a C minus area? The return profiles change, right? And how frequent are we doing this? Are we buying buildings every year, or are we buying buildings every 5 years? So something to consider as far as your plan and how aggressive or not aggressive you want to be. But here's a basic return profile. Now, I want to take a real quick second to tell a story, because this just happened this week, to kind of make this real. Because when I first looked at this, it's kind of like, I get the math. I'm a math guy. I get it. But is it real? I've experienced it with my family. It's gone through tragedies. I get it. Someone walked through our door 2 days ago. I shouldn't maybe say his name, but he used to work with Buckingham Investments back in the 80s. And he just happened to be having lunch. We're in Old Town Torrance. He'd been happened to have lunch down the street, and he's kind of wandering around, and we could kind of see him through the window. And he opens up the door and he comes in and he's like, "Is this Buckingham Investments?" "Yeah, how's it going?" "I worked for Buckingham in the 80s. I was with TRW, and I still own all the buildings that I bought." And so I start talking to him. I'm like, "I have to talk to you." And I'll save you the story because I think we're going to get him on camera and we're going to do a cool thing. But he was buying properties in the 80s at interest rates that were double than what we're experiencing now. He made comment of that. And maybe the buildings didn't cash flow year one or whatever. He owns every single building to this day. He has multiplied his doors. He lives in Manhattan Beach. He was able to retire way earlier than he thought. And when I was talking to him about us doing this presentation today and I was showing 5% return, 15, 30, he's like, all of mine have been over 30% returns without a doubt. He didn't even bat an eye. And it was really impactful for me to hear that because I've seen my family story. I know Jack Buckingham, Marty's story, Anthony Walker's story is amazing. I'm sure some of you heard that. But to hear someone outside of that who just happened to walk in the doors and tell his story was fantastic. So I can't reiterate enough that this is math, just mathing, and it might seem like big numbers, but it's very real if you are, tried true to the strategy and you are consistent with what we're doing. So I'll stop with the storytelling there, but I thought that was just super cool that made these numbers even more real from a perspective over 40 years ago. Thought it was awesome. So diving into the next illustration, this is another representation of how this works. Future value. We have present value on the left-hand side with a couple chunks, 50,000, 100,000, all the way to 300. We have a couple year intervals, 10 years, 15 and 20. We have a couple return on equity markers, 20, 25%, and 30 when we're combining all four elements of return. It's very real. And the future value is the big numbers in the middle. So this is just another illustration of if you're thinking about planning and you're thinking about diving into this type of journey, this is the start of where you guys get to have some fun. Where do I want to be if my equity position is $10 million? What does that afford monthly cash flow of 5% return on equity? What does that monthly cash flow turn into my golf membership, paying for my daughters, going on a boat, whatever, right? This is the fun part of it. So we'll move on from this quickly, but we calculate all these numbers on a daily basis and we just try to illustrate it because it's a lot in a simple way. So let's plug and play. So first action step of today was if you're going to work with the right team, make sure you vet them. And we talked about some vetting process that you can put your real estate team through, or you could come vet us and see if we're the right fit for you. The second action step that you can take away is I highly suggest you create your own plan. It starts very simple, but if we don't do it this way, it's very easy to get lost. Why am I dealing with this tenant? Why do I have to get new insurance on my building? I forgot why I'm doing this when all these little things are popping up of real estate ownership. This is important to come back to. So to illustrate
Or
it,
even getting, if I can jump in real quick too,
yeah,
Matt, this really helped me because I was stuck in analysis paralysis before I met Buckingham. Like I thought I want, like I mentioned, I thought I might want to flip properties, but I was just doing analysis after analysis after analysis. It wasn't until I was at Buckingham and I felt we created a plan that helped me decide which route to go and if a property actually made sense or not. So just something to think about long, bigger picture helps us guide us with all of our decisions that we have.
it's a good point. Some people start with, how do I make this property work? I got a property, I'm going to buy it, I'm going to make it work. I think it's more important to start with, what's my plan? What's my goals? And then sift through that to find the right property, to what Chrissy's mentioning. And this is the start of it. So make this real for you would be my advice, or not. Totally your call. But I think it's important to figure out your future value, because if your future value like this is, let's say $6.5 million, what does that mean for you? That's a portfolio, great. That's properties you own, awesome. But what does that mean for me? You're going to collect 5%. That's a cash flow number now. Now we're talking about cash flow. You're going to collect 5% off of that position. So in this case, 5% is going to be $329,000 annually or $27,000 monthly. Down the road, not today. It's a get rich slow strategy down the road. Okay, so it's important to mention that. All right, so we did the charts. We got some action steps. Let's talk about these crazy rates of return. A guy came in and said 35% and more from the 80s. Where are these returns coming from? Well, you have four of them. You have, everyone knows cash flow, but we'll cover it. You have your rental income. This is a business. You have your operating expenses and expenses in general, and whatever's left over is yours. It's not easy to cash flow day one. That is the truth. And if you're a cash flow investor, we could talk about how we could get it to cash flow day one. But those are cash flow strategies that we can talk about offline. But it's important to remember cash flow or a path to cash flow, which is probably more important in today's marketplace. Second to return is tax shelter benefits. We are not going to be a CPA today, and we are not giving tax advice. However, there is a lot of tax benefits, and most of our clients recently are buying, I don't want to say purely for the tax benefits, but due to the recent bill, almost purely to the tax benefits. The recent big, beautiful bill, ignoring all the politics aside, removing that trash for a second, but how it affects real estate investors is really important. And we could talk about that offline, but it's a return that we calculate, tax shelter benefits. Equity buildup through amortization. If we're getting a loan on this building, and yes, I'm paying the loan on a monthly, but who's paying me to pay the loan? My tenants, right? So 2, 3, 4 years down the road, I start out with a $500,000 loan on that property. It's now a $400,000 loan. That $100,000 is a gain, and I didn't have to pay for it. I collected rent from my tenants who helped pay into my savings account. So that's another return that we're going to calculate. And the last one is appreciation. We have a phenomenal market here in Southern California. There's other markets, New York, Hong Kong, Tokyo. Supply and demand is what we need to consider here. We have almost no supply left, and we have a ton of demand, which is feeding high rates of long-term appreciation. Also, inflation. Inflation is always in the news nowadays. Tariffs, inflation. Owning real estate is a hedge against that. Higher inflation, typically higher values, right? That's how these things go, or higher rents. If everything in the marketplace is going up, so are the rents. If the rents are going up, the value of my building is going up. Okay. So these are the 4 elements of return that we're going to calculate on any building that we're looking at or any building that we currently own. So I think it's important to look at those and make sure your goals are being achieved through these 4 elements of return. But if you combine these, that's where you're getting to the 20, 30, whatever percent return we're looking at is the combination of those 4 on a monthly or annual basis, depending on what we're looking at. So appreciation is a big one, especially in our local market. And here's some of our, data nerdness coming out. We love data. This is a massive chart that is pretty underrated here. On the left axis, you're going to have a cost on a price per square foot basis. And down below, if you want to squint like me, it starts in 1965 all the way till last year. And yes, on a price per square foot basis, it was $14 back then, believe that or not. So what this chart is South Bay, only apartments, think LAX down to Long Beach. Every apartment that is sold, we track, whether it's our sale or not, we track it. And we do it on a quarterly basis, which I'll show you next, but this is our annual basis. Okay, a couple things to note. Year over year, we have a 6.25% appreciation. You own a building, using averages, 6.25% per year is the value increase of your building, just by participating on an average basis. Now, yes, we have cycles. Again, we're not timing the market here, but there are cycles to pay attention to. I think the most important cycle to pay attention to is how every high is surpassed by a new high. That is very different in most of the country, especially in some of the states that enjoyed some of the COVID money. This supply and demand metric is not met there. They don't have a high being surpassed by another high. They have too much supply. That's not the case here. So you have a high, back in 2007 of 329, and that was quickly surpassed in 2016 after we rebounded after the biggest crash that we've ever experienced, right? But it's important. If you're doing this long term and you're starting in 2007, like we bought a building in 2007 and we sold it in 2018. We didn't realize any loss, right? We cash flowed the entire time. We didn't time the market. We just participated in the market. So I think it's important to participate in a market that meets your goals. And if your goals are long-term investing like ours, this is the type of chart that you want to see. And if we're going to do some timing for a second, yes, you have seen 2 years of decline. in 2023 and 2024. I'm not going to say it's time, but it's time. So, with that being said, we'll move on. This is our quarterly market study. This is what we do every quarter for our clients. This is free. We take all the data, like I said, from CoStar, MLS, all the various sources. We condense it down to what you're seeing here. So you're going to see the cities that we catalog. We also have an Excel spreadsheet version of this that actually takes each city and breaks out each subsection of the city. But for now, we'll just do broad strokes. So you have the cities, you have the number of sales or transactions within those cities or grand total within the quarter. You have your average cap rate, you have your average gross rent multiplier, your average price per square foot, and your average price per unit. If you don't know those, we could talk about them later. But the point of this is we track them. And this monthly data goes into that annual bar that you saw. What you'll notice here is this is the first quarter from Q1 to Q2 of this year. This is the first quarter we actually saw an uptick. As you saw in the previous chart, we've had 2 years of decline. This is the first quarter over quarter that we actually have an uptick in all the metrics. And what you'll notice here is on a price per square foot, we have 514 in this market study. If we go back to the previous slide, you have your annual at 487 for 2024. So I'm not calling the bottom. Maybe I am. I'll let you guys decide where we are in the market. But the data is pointing there might be a nice bottom forming and we might be on an uptick. So not timing the market, just important things to consider. And it's also important, what market are we selecting? Do I want to invest in, Carson, I own in Carson, where I'm paying $473 on a price per square foot? Or do I want to be in Hermosa Beach, where I'm paying $1,623 on a price per square foot? Again, depends on your goals. One might be right, one might be wrong in relation to your goals, though. So I think it's important to pay attention to the data, but we can move on because I could tell I'm data nerding. And if you want a copy of that, we're happy to provide you our quarterly market studies. All right. So table is set. You know who we are. You know a little bit about our data, where these things come from. These are the same conversations that we've had with Mike. Okay. So Mike, this is case study number 1. Mike is a client of mine, Redondo Beach local as well, hardworking individual. He's using retirement funds. He put together a solo 401k back when I met him in 2018 and didn't have a way to invest it. It was a little bit of a challenge, but that's his starting point. He wanted to buy something that easy, stable, put his retirement funds to work because it wasn't doing anything else with whatever other vehicle he was doing and putting it in. And so we bought this 4-unit for $757,000 in 2018. Units were in good shape, very turnkey, more or less turnkey, and very stable. Didn't have to kick anyone out, just put a loan on it, which was rather challenging to get a loan for a solo 401k, but we did it. He had to put 50% down. Terms weren't as good, but we did it. 2022 comes around. Stay with Mike every year. We're touching base. How's the property going? You could raise your rents here. You could trim expenses here. 2022 comes around, time to refinance. Mike was able to pull $500,000 out of that building by not spending a dime. I think he had 1 unit turnover in that course of time, 1 tenant left during that period of time. So I don't want to say it's easy money, but some can call that easy money. But regardless, purchase strategy 2018, 2022 refinance strategy. He kept the 4-unit in place, put a new loan on it, paid off the old loan, and he kept $500,000 tax free. There's no taxable event there, FYI. And the property value was 1.25. And that's a function of appreciation, raising rents, so on and so forth. So 2022, he tasked us, let's go find another building, very similar to the one that he bought in 2018, which doesn't exist. But if you'll notice, 2022 to 2025, that's a 3-year period working with Mike. Been working with him from the very beginning, multiple written offers, multiple property portfolio analysis, Whatever we needed to do, we did it, and we finally landed on the right building. And he was able to purchase another 4 unit. It was only a couple months ago for $1.4 million. A great 4 unit, super stable, rents are solid, has some upside in garage ADU potential, which is what he wants to do eventually. But this is a great scale strategy for Mike, who is low leverage, low risk, putting his retirement funds to work, and he's doubled his doors in a decent period of time. 7 years is a good period of time of doubling your doors. So when you're thinking about scale, scale can mean anything, right? That's a pretty vague term. Think about this on this side of the scale: low and slow, low risk, nicer locations, nicer buildings. Great strategy. Fits Mike perfectly. And there's an arrow. I guess there's no arrow, but Mike is getting ready to potentially buy again next year. His son has graduated, and his son now wants to get involved. So the story continues with Mike. So that is scale strategy one. We'll call it low and slow, nice and easy. It's as passive as it comes, fully managed, didn't have to deal anything, lift a finger. So scale one. Chrissy, any points on scale one?
No, you said it. It was very low maintenance, very, he didn't have to put a lot of his time into it. Very passive, like you said.
So let's go to the opposite end of the spectrum and let's talk about Paul. So Paul, another good client, have become friends with Paul. This one is going to be on the opposite end of the spectrum. This is going to be in the commercial asset class. What we were looking at before was the 2 to 4. That is the residential. You can get residential loans, and we can talk about that offline, what that means. This is the commercial asset class. Same thing, basic human need. Where the loan changes is 5 units and up. Anything that's 4 units or less is a residential loan. Anything that's 5 units and up is considered a commercial loan. So we're trying to give you guys both sides of the perspective here and different asset classes as well. So Paul, he wanted to scale very fast and he wanted to take on a lot of risk. He's talking bridge loans. Those are hard money loans that are due in 12 months, talking about kicking tenants out, cash for keys, talking about, renovating all the units, releasing all the units. In this case, he bought a 6 unit in Long Beach in a okay part of town. And we got it off market 930. There was no leases. The garage was falling over in the back. We had to rebuild it. That was a part of our plan. It needed a lot, if not everything, but that was the plan. That was the goal. Sourced it off market. Perfect building for Paul. Paul was able to quickly renovate it. We sold it the next year in 2019. And this is where he didn't refinance and buy another one like Mike. He sold it and did a 1031 exchange. Again, no taxes paid. All the taxes there are deferred. And so he took his renovations, did well, built a brand new garage in the back, sold it 2019. We helped him at 1.4 million. And then a couple months later, we did a 1031 exchange with roughly $650,000 of proceeds. And we turned that 6 unit into a 14 unit that we purchased for 2.7 million with Paul. That strategy was also aggressive. He didn't buy it with a bridge loan. He bought it with what was called at the time a market rents program, where the loan of that building, the 14 unit, was underwritten at what market rents could be. And so he had to go through the first 12 months and get those rents that were lower than that up to speed. So there's a whole process. We could talk about that there, but high risk, let's call it high risk, high leverage, also high reward. He was able to do 3 transactions within 2 years roughly, and he was able to take 6 doors and turn it into 14, all within the same chain, meaning no new money. He rolled the money from one purchase into the next. I think that's important to note. So value add is cool. That's kind of my strategy. I align more with Paul than I do with Mike. Chrissy may align with someone different. You may align with someone different. That's the point of this conversation, is kind of see different perspectives and where you might fit. But very aggressive, very risky, but the return profile fit and it worked out for Paul. The next slide is going to illustrate Paul liked the strategy so much that he kept one, we're kind of visual people, he kept one seed planted and turned 6 units into 14. And that 14 unit, he refinanced out of that market rents program, and he's sitting. He's cash flowing. He's waiting for the next releverage point, which will probably come up next year. So next year, that might turn into 28 units. We'll see. But everything went so well that in 2021, Paul got excited again. We bought another building in Inglewood, a 6 unit bridge loan, went through the whole thing again. And he was able to get tenants out, refinance, get the value up. And again, he's sitting on the equity that he's built over the 14 units on the one train above and on the 6 units below. That's scaled to 20 units in a couple years. That's really aggressive scale. But we planned for it. We saw every objection and hurdle along the way. And our ecosystem really helped Paul here. We provided everything for Paul to make it easy, from contractor to the cost segregation person who was able to force accelerated depreciation on the first building he bought, and all these different strategies we could talk about. But we plugged him in to make sure he was comfortable and he was able to execute these things. So this is where the next slide is going to kind of be our next and last action step as far as what does scale mean to you. I think is really important to plan for now. Don't just buy a building and figure it out later. Don't get involved with that uncle. I'm buying this building and let me, get that money involved and figure it out later. Figure it out now before you do any of this. And I think it's important to define your scale that is in relation to your goals, that is also in relation to your starting point. Are we going to be like Mike, turnkey, great condition, tenants are paying market rent, I don't have to release it or deal with anything, there's almost no maintenance on this thing, I'm in the 2 to 4 unit asset class, so I got residential loans, 30-year fixed financing, right? I'm using my retirement funds, I can't touch them anyway, so might as well get them growing, right? And I'm not using a lot of loan products. Or are we more like Paul? Give me value add, give me the ugly one that I could, put renovation money into. I can also get the tax benefits of the bonus depreciation of all that money that I'm spending. The tenants are paying $500 when they should be paying $2,000. I got to deal with that. I got to pay them to leave, right? I got a lot more work and management to do, show up to the property, make sure the plumber shows up, this and that, right? 5 and up unit space, bridge loans to conventional. We're on adjustable rate debt. It adjusts every 5 to 7 years. I'm adding new cash. It's awesome. Nothing wrong with either strategy, but I think it's important to note you want to find the one that fits for you. Don't try to fit the strategy, have that strategy fit you, I think is really important here. So take the time to plan, but more importantly, where do you fit within this spectrum? Anything there, Chrissy, that I missed?
That's good. Like you mentioned, it's anywhere that fits your goals. Everyone has different personality types, different risk tolerances. So let's find the plan that best fits for you and what you're comfortable with.
Absolutely. And, I think along with that, a couple things here are going to be getting ahead of locational value, getting ahead of who is my tenant. These are other things to consider. What is my tenant base? What's the demographic? What's the median income, right? Am I going to do a refinance? Am I doing the BRRRR method? Am I intentionally keeping the building to buy another one? Or am I going to be a flipper? And that's okay either way, but we need a plan for those strategies because there might be taxes that you weren't aware of that we need to be able to defer or get around some way. So I think it's important to consider a lot of these things when you're considering your scale or the scale within the strategy.